In this video, let's talk about how to invest $10,000 in Australia, especially if you just started your investing journey. Hey, what is up everyone? It's David here. I was asked this question multiple times over the last couple of months, and instead of writing massive essays on the YouTube comments, I decided to make a video instead. As usual, I'll wrap up this video with a portfolio update and all the timestamps are in the description box below, so feel free to jump to a section whichever that interests you the most. Now, because I'm just some shaved head, random Asian dude on the internet, I'm not qualified to give any financial advice. So please don't use this video as financial advice. So without further ado, this video is sponsored by
you gently smashing that like button.
I got that from Graham Stephan. I thought that was really funny when I saw it, so I was hoping to brighten your day up a little bit as well. Anyway, without further ado, let's go! Now, since this topic is really well covered, I condensed everything into 3 simple steps. And for people who are really keen, I'll talk about 2 extra ideas on how you can invest $10,000 that's slightly out of the box. But first things first, with $10,000, the first question is, do you have an emergency fund? Now, life is incredibly unpredictable, and when life throws you a lemon, you want to be prepared to make lemonade. On top of that, if life throws you an opportunity of a lifetime to invest, aka a stock market crash, you want to make sure that you make the most of it when the opportunity shows itself. Now, with emergency funds, the rule of thumb is that you should have 3 to 6 months worth of expenses tucked away in a high interest savings account so that it's readily accessible when you need it. Now, frankly speaking, it's perfectly fine to just start with 2 to 3 months worth of expenses tucked away in an emergency fund and then slowly build it up to 6 months and then 12 months worth of expenses. So for high interest saving accounts, the interest rates are anywhere between 1.5% to 1.7%. So try to look for saving accounts with an interest rate above 1.5% and make sure you read the terms and conditions on what enables you to get that interest rate. Anything lower than 1.5% interest rate is probably not worth your time, and you'll get a higher return by just gently smashing that like button and me creating more high quality videos for you. Now, jokes aside, I found a resource that compare high interest saving accounts here in Australia, so I'll leave a link in the description box below for anyone who's interested. Now, the second step is taking care of your high interest debts. Now, by high interest, I'm referring to, do you have any debt that's above 10% interest rate? I personally will use the $10,000 to pay off the high interest rate debt before I consider investing. Why? Because at the end of the day, we know that the stock market generates anywhere between 8 to 9% if you stay invested for a 30-year period. And if you have high interest rate debt that's above 10%, it means that all of your stock market returns will be eaten away by the high interest rate debt. Now, step 3, assuming that you don't need the $10,000 in the next 12 months, you want to put that money to work by dollar averaging into assets that appreciate in value over time. Dollar average just means that you're investing the exact same amount, either monthly, quarterly, or even weekly if you want. That is, instead of investing the entire $10,000 into the stock markets next month, you can dollar average $2,000 every single month for the next 5 months. Now, the reason why we don't want to put the entire $10,000 in the stock markets immediately is because we have no idea whether the stock markets will go up, down, or even sideways. If you invest $10,000 tomorrow and the market crashes 30%, you lose $3,000 and your confidence as an investor will be shattered. Whereas if you consistently just invest $2,000 every single month for the next 5 months, even if the market crashes 30%, you'll only lose $600. But the downside is that if the market goes up 30% tomorrow, then of course you'll gain more by just putting that entire $10,000 into the market right away. But the challenge with that thinking is that your timing has to be right. And I can tell you that there is absolutely no way anyone can know what the stock markets will do tomorrow. And with that, the simplest way is to dollar average your way into assets that will appreciate in value instead of putting everything into those assets all at once. So then the next question becomes, what assets should we choose to dollar average our way in? Personally speaking, government bonds and term deposits returns are so bad that you'll just get a higher return by leaving your money in the high interest rate savings account. On a serious note, a 2-year Australian government bond yield will return approximately 0.24% after 2 years. and a term deposit interest rate is anywhere between 0.5% to 1%. But inflation in Australia is approximately 1.4 to about 1.6%. So that essentially means that if you were to invest in those assets, you're guaranteed to lose money. And although that gold and cryptocurrency does have a role in most investors' portfolio, the fact that you're watching this video, let's build up our confidence first and then come back and revisit this asset class. Similarly, for property, trying to own a home with $10,000 in Australia is as likely as seeing an Asian dude on The Bachelor. The point I'm trying to make here is that trying to own a home with $10,000 is very unlikely because the median price for a home in Sydney is approximately $1.1 million and a unit in Sydney is approximately $700,000. Yes, it gets a little bit less when you move out to different states, but honestly, we can come back to this asset class when we have more capital. That leaves us with stocks. If you're not comfortable doing research and picking your own stocks just yet, then the best way is to dollar average into a low-cost ETF. Now, I made a full video on Australian low-cost ETFs, and I'll leave a link in the description box below for anyone who's interested. But to save you some time, I'll mention a few here that will get you started researching. Now, you're probably familiar with the first one, and that's VAS. Now, VAS is a Vanguard ETF that tracks the ASX 300, which really just means the top 300 companies on the ASX. Now, the management fees are 0.10% per year, and over the last 10 years, it has returned approximately 7% per year. Now, this ETF is great for investors who want exposure in Australia and wouldn't mind dividends along with a bit of share price growth. Now, another ETF that's really worthwhile mentioning is VTS. Now, VTS is another Vanguard ETF that tracks the entire US market. And the management fees are dirt cheap at 0.03%. And over the last 10 years, it has returned 16.26% per year. So this ETF is great for people who want exposure into the US market. And for investors who want exposure into the entire world, IOO is a BlackRock ETF that tracks the top 100 companies in the world. The management fees are a little bit higher at 0.4% per year, and over the last 10 years, it has generated 12.35% per year. Now at this point, you must be wondering, why didn't I talk about superannuation? Now the main reason why I didn't include super on this list is because I want to be financially independent in my 30s, and contributing to super doesn't make sense for my goals because I can't access the money till retirement age, which is in my 60s. Superannuation actually makes more sense to me when I reach financial independence and ultimately at the top tax bracket. Because at that point, I want to minimize the taxes that I'm paying, and contributing to super actually makes sense. Now, for people who are extra keen looking at out-of-the-box ways to invest $10,000, one of the ways to invest that money is via education or courses that will help you earn more as an individual. Till this day, I'm continuously investing in sharpening my skills as a marketer, and I'm always looking for ways to reinvent myself. Why? Because one, if you're so good that they can't ignore you, you will be pandemic and recession proof, my friends. And two, because you can only save and invest so much. At some point, you have to work on earning more as an individual. The second idea might sound a little bit controversial, but use some of that money to buy coffee for people that you admire. And admiration, I'm really talking about professional admiration. And this is largely linked to the first bonus idea, because if you haven't taken the time to work on your craft and sharpen your skills, the people that you admire is not likely to take notice or even accept that coffee invite. But if you have worked on your craft and people can see it and you're genuinely curious about working on your skills and looking for mentorship, people will take notice. Till this day, I'm continuously investing in my relationships, and I'll always surround myself with people that I genuinely admire, and whenever the chance comes, I'm buying coffee or lunch with no expectation of anything in return. And when you do this consistently and out of good faith with no expectation of anything in return, I can promise you that those investments will be the greatest investments in your lifetime. Now, before I do a portfolio update, if you want access to my video scripts, my research, and also be part of my fortnightly Q&A, not to mention some additional content pieces, consider supporting this channel via Patreon. Now, I'll leave a link in the description box below for anyone who's interested, but nevertheless, it already means the world that you're watching this video. So thank you very much, and let's jump into a portfolio update. Now for the CMC markets portfolio side of things, it's currently worth $55,645. Now, as many of you know, I use CMC markets to do majority of my Australian stock investing, and I use ShareSite to do majority of my portfolio tracking because it looks much better over here than the CMC markets side of things. And since last week, majority of the movement has been Argo Investments announcing their 14 cents dividends per share, and also VTS continuously moving up. Now, VTS is an Vanguard ETF that tracks the entire US market, and currently, as it stands, it's very unlikely for the US president to allow the stock market to tank, only because he wouldn't want anything to hurt his possibilities or chances to be re-elected. So if anything, it's unlikely for us to see a correction during this period before November 3rd, which is when the new US president will be announced. And only after that point, that's when I think we will really see what the economy really looks like. Now, on another note, WAM Research has finally gone back to positive when it comes to capital gains. So I've been pretty happy about that. But I do want to remind you that it's very natural for us to encounter a stock market crash again in the future, or a correction. So don't be too fixated on your returns because you want to continuously invest. Honestly, you just have no idea what's going to happen tomorrow or the day after. So for me, I'm about to invest the September portion of my capital into my portfolio, and I'll let you know what I decide to do with that money. Now for my stake portfolio side of things, it's worth approximately 11,000 plus 1,000. So that's 12,000 US dollars, which is approximately 17,000 Australian dollars. I didn't buy anything last week, mainly because I had to wait for a lot of the unsettled trades to go into buying power so that I can actually buy something with it. At the same time, I am waiting for Apple and Tesla to finish its stock split until I make a decision on what I am going to be buying next. Or I'm completely waiting because the situation over there in the US, especially the social situation, are very, very messy at the moment. So I'm just observing, and I'll tell you next week exactly what I'm going to be doing with my money. For those of you who are watching my videos for the first time, I just want to let you know that I am predominantly a dividend growth investor. But at the same time, I do value growth stocks. So that's one of the reasons why I have ARK, Tesla, and also AMD on that front. And Dropbox and GoPro are actually not part of my portfolio, and these are free stocks that's given to me if you do try stake for yourself. Now, the reason why I use stake is because with CMC markets, if you do decide to buy and sell US stocks over there, you do have to pay brokerage and also foreign exchange fee every time you buy and sell. It's just very expensive compared to stake, where you only have to pay a forex fee and the rest of the buying and selling is brokerage free. On that note, I'm not sponsored by Stake, and if you want to try Stake for yourself and wouldn't mind a GoPro, Dropbox, or Nike, I'll leave a link in the description box below. So thank you for watching this video all the way to the end. If you learned something brand new, just make sure you gently smash that like button right there, and that would mean the world to me. And also consider subscribing, clicking on the bell so that when I release future videos, you be the first one to know. Until next time, my name is David. Auto will always do the honors, and see you very, very soon.